This is WealthBT, a podcast of BT correspondents.
2024 is in the rearview mirror, and what a year it was. Despite uncertainties, it turned out to be a very good year for investments. Equities had a fantastic performance, even Singapore stocks. Bonds had a more muted year, but we'll be looking ahead into 2025. What key developments are likely to impact you, both financial and non-financial? How should you set your expectations for returns in 2025? Most of all, this is a good time to take stock of important aspects of your life, your portfolio, health risks, CPF, and ways you can enhance your biggest asset, yourself. Welcome to WealthBT, a podcast by BT correspondents. I'm your host, Genevieve Cua, Wealth Editor of the Business Times. Every week, my colleagues and I break down a business story that matters. Here are 5 pointers in a checklist that can better your well-being, not just for 2025, but also for the years ahead. First off, your portfolio. What's a realistic outlook for stocks and bonds? 2024 was an outstanding year, especially for U.S. stocks. The S&P 500 closed the year 25% higher after gaining 26% in 2023. Even the Straits Times Index surged with a return of more than 20%. But fixed income was more challenging. Up to around the third quarter, investment-grade bonds were on pace for a return of around 5%. But in the fourth quarter, a more cautious Fed and worries about inflation caused yields to spike and bond prices fell. By the year end, fixed income inched up just slightly by 1 to 2%. In both equities and bonds, it's prudent not to expect too much. A December survey of fund managers by Bank of America found them super bullish on stocks. Allocations to cash were at a record low, and allocations to U.S. equities at a record high. But here's the thing. Historically, it's a sell signal when cash levels drop to 4% or lower. That is, markets may be toppish and are poised to drop. Valuations are another reason for caution. You still can't do without an exposure to the U.S. because it remains the world's largest economy, and it's the powerhouse of tech and innovation. But when stocks go up at the pace we've just seen, valuations become worrying. Ultimately, nothing defies gravity for long. The S&P 500 is currently trading at a price-earnings multiple of over 27 times, compared to the 10-year average of 18 times. Some experts believe that the potential for gains this year may be in a high single digit. Still pretty good, but maybe less than half of what you earned in the past 2 years. Second is the trend in interest rates and inflation. Trump has made several threats on tariffs. The one thing most experts agree on is that inflation is set to rise as tariffs raise costs for almost everyone. So far, Singapore's core inflation in November was on a downward trend at 1.9%. But there is uncertainty. Late last year, the Fed reduced its indication for rate cuts this year to 2 cuts of 25 basis points each. But some believe there may be only 1 cut or none at all. Hence, rates may remain higher for longer. Yields on U.S. 10-year Treasury bonds have been rising and may hit 5% this year. For investors who already hold bonds, this may spell a capital loss. But then, it's also a chance to reinvest at higher yields. The silver lining for savers who seek low-risk options is that rates on fixed deposits and T-bills may remain attractive, but you'll need to be careful. Rates may be volatile and may not keep pace with inflation. Third is changes in CPF, and there are several this year geared towards enhancing your retirement savings. Here's a very brief list. It's not exhaustive. 1. The wage ceiling for CPF contributions rises to $7,400 from $6,800 a month. This means more of your salary goes into the CPF. This reduces your take-home pay, but overall, A higher CPF contribution means more retirement savings. That's a good thing. 2, for those 55 and older, the special account will be closed, and the excess savings there channeled into the retirement account, up to the full retirement sum. If you still have excess funds after that, it goes into the ordinary account and earns 2.5%. 3, the full retirement sum is being raised, as well as the enhanced retirement sum, or ERS. The ERS will now be twice the full retirement sum. In 2025, this comes to $426,000. If you top up to the maximum in ERS, you can receive up to $3,300 in CPF Life monthly income from age 65 for life. We've just been going through a checklist for your well-being in 2025. In a moment, we'll look into a novel approach to an asset that we don't appreciate enough, ourselves.
Money Hacks by the Business Times delivers useful financial tips every Monday. Subscribe to the playlists in Spotify, Apple Podcasts, or wherever you listen to podcasts. But if watching is your thing, we've got you covered. Subscribe to the Money Hacks playlist in the podcast tab of BT's YouTube channel and watch as Howie Lim gets the inside scoop on the best money hacks. Subscribe and watch today.
And now, back to WealthBT, a podcast of BT correspondents.
Welcome back. So far, we've touched on 3 things on our checklist. The 4th thing is medical inflation. Last year, it was more than 10%. This is unlikely to fall for many reasons, including Singapore's aging population. But this year, I think you'll have to brace yourself for higher integrated shield premiums too. This was on the cards following the MediShield Life review last year. The review recommended enhancements to MediShield Life, which will raise premiums of this basic cover. But to me, one of the most significant recommendations is the reduction in the proration factor, which impacts integrated shield plans. Proration refers to the amount that MediShield Life will pay for a claim before the IP cover kicks in. A lower proration factor means that IPs have to foot a greater share of the hospital bill. Proration factors are being reduced across ward types. This means the premiums of even IPs catering for public hospital wards, Class A and B1, may also rise. We'll have to wait and see how insurers approach this, but I think we all need to reconsider carefully our expectations for healthcare and premium affordability. Is your preference for the most luxurious private hospital wards? At older ages, like 70s onwards, private hospital plans are likely to cost thousands of dollars a year, especially if you also pay for a rider. So overall, how should you approach 2025? On investments, I believe in staying balanced and rational. This is a good time to revisit your strategic asset allocation, which is the mix of core investments to get you to your financial goal. Whatever your asset balance, you may find that strong equities performance would have tilted that balance towards higher risk. It may be prudent to trim this according to your capacity for risk. It's not wise to try to time markets or to take a large position in a single stock. Frankly, at this stage, even market experts are uncertain how 2025 will pan out because of geopolitical risks, Trump policies, and most of all, higher valuations. Diversification helps even though you may not score the highest returns. It helps you to stay invested, and you'll reap the rewards of compounding too. There's one more thing on my checklist, and it's non-financial. What do you feel about the prospect of living to 100? Does it scare you? It's scary to me, not just because of finances, but the care arrangements I'll have to make for myself. There is a very good book by Andrew Scott and Linda Gratton called The 100-Year Life. I recommend this book because while it doesn't talk in great detail about financing a 100-year life, It offers a very different perspective of your entire lifespan. As the book says, we typically think of our lives in 3 stages. The education phase starts from birth to early 20s. Then the career phase is from your 20s to mid-60s. And finally, 60s onwards is retirement. But as the authors write, we need to get away from this static thinking, especially as our lives get longer. Why should education be confined to the first 20 to 25 years? And why should work stop at 60? If we live until our 90s, we may have 30 years in retirement. Instead, education can be sprinkled over various phases of our lives so that as we reach the end of a traditional career, we'd be equipped to work at something different and personally fulfilling. This may or may not earn an income. Most of all, it helps to think of ourselves as an asset in 3 dimensions. One is the productive aspect, which refers to our skills and knowledge, and also social capital, or the network of friends and contacts we've built over the years. Second is what the authors call vitality assets, which refer to physical and mental health and the sense of well-being. And then there are transformational assets, or our ability to be open to new experiences. All that puts us in a good place with resources for more fulfilling lives. I hope this episode helps to give you some ideas for 2025. I wish you a rewarding and fulfilling year ahead. BT Correspondence will be back next week with a new episode on transport, so do check it out. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm Genevieve Cua. As always, thank you for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.